Good morning, good afternoon, good evening. My name is Market Maker 69420, and in this episode, we're going to talk about the Friday market close. Friday's market close delivered a stark reminder of lingering vulnerabilities amid turbulent Friday wrap-up. Hotter than expected wholesale inflation data, renewed AI disruption anxieties, and unsolved U.S.-Iran geopolitical tensions fueled a divisive risk-off move, sending equities lower while lifting safe-haven assets like gold and oil. This dynamic set a cautious tone for the weekend, with potential spillover effect across interconnected markets as traders manage positions and monitor overnight developments. Let's talk about the stock market. The major U.S. indexes closed decisively lower on Friday, February 27, 2026, capping a choppy month marked by AI-driven volatility and inflation concern. The Dow Jones Industrial Average finished at $48,977.92, shedding 521 points, down 1.05%, led by heavy losses in financial heavyweights like Goldman Sachs, American Express, and JP Morgan Chase. The S&P 500 closed at approximately $6,878.91, down 0.44% or 30 points, while tech-heavy NASDAQ Composite dropped 0.92% to around 22,673, reflecting ongoing pressure on mega-cap names, including further weakness in NVIDIA despite its recent earnings beat. Overall, direction was bearish, with the session erasing earlier modest gains and pushing the S&P and NASDAQ towards their worst monthly performances since March 2025. S&P 1.5% lower for February, NASDAQ 2.5% down, while the Dow still eked out a slim monthly gain but snapped a longer win streak. Volume and liquidity appeared solid, but not exceptionally heavy for a Friday month end, consistent with elevated volatility rather than panic liquidation. Markets remained orderly with tight spreads, though liquidity thinned in after-hours trading. No major options expirations or pinning dynamics were at play. February monthly expirations had already passed. This was not a quad-witching day, allowing price action to reflect fundamentals and sentiment drivers more cleanly. Sector rotation favored defensiveness. Utilities, staples, healthcare showed relative resilience, while financial and technology bore the brunt of the selling, highlighting narrow breadth with more decliners than advancers, and the S&P 500's Magnificent 7 components dragging the index. The VIX spiked notably, jumping from prior close of 18.63 to around 20.74, up 11 to 12%, pushing back above the 20 fear threshold and signaling heightened implied volatility expectations into the weekend. After hours futures traded mildly softer. Dow futures hovered near 48,948 levels shortly post-close, pointing to a cautious Sunday night open with limited pre-market catalysts expected absent major news. News flow was dominated by the January PPI report, 0.5% MOM versus 0.3% expected, with core also hotter, reinforcing sticky inflation, dimming near-term Fed cut hopes. This compounded AI jitters from Block's 40% layoff, explicitly citing AI's efficiencies and persistent tariff geopolitical overhang. In economic and technical context, the close underscored a shift from AI euphoria towards skepticism, with the S&P 500 retreating from recent 7,000 attempts and testing port near 6,800 to 6,850. Broader macro backdrop features resilient growth, but policies uncertain, setting up potential mean reversion or consolidation into March. When looking at commodities market, commodities provided a counterpoint to equities weakness, closing higher overall on Friday amid safe haven buying and geopolitical risk premium. Gold settled strongly around 5,260 to 5,280 per ounce, up 1.5%, extending its bullish run as falling real yields offset the hot PPI data, with silver surging more aggressively towards $92. WTI crude settled near $67.24, up 3%, with Brent around $73, boosted by stalled U.S.-Iran talks and weekend supply disruption fears. Other metals and energies followed suit in a broad risk-on, risk-off divergence. Position management took center stage heading into the weekend, with traders lightening exposure or hedging amid evaluated geopolitical tail risk. No major rollover event today, but March contracting positioning likely saw adjustment given month end. Liquidity and volatility patterns were elevated but constructive for bulls, with orderly trading and no evident squeezes. Open interest remained healthy without dramatic spikes. Macro and fundamental news flow centered on persistent inflation, supported for gold as a hedge, and renewed Middle East tensions lifting oil risk premium. Technical levels showed gold breaking higher with strong order book support, while oil tested and held above 66 resistance. Broader market sentiment turned commodity friendly, equities risk-off move channeling flow into hard assets as inflation and uncertainty persisted. Now let's look at the cryptocurrencies market. Crypto markets mirrored the broad risk-off tone, but with relatively concerned moves, closing the week mid to low amid higher correlation to equities. Bitcoin traded around 66,000 to 67,000, down 1 to 2% intraday, with levels sighting near 66,234 to 66,300 in late trading, while Ethereum hovered near 2,038 138, down 1 to 4% on the day. Liquidity levels were decent for a Friday, but thinner than midweek peaks, with spot and future markets showing reduced depth post-equity close. Volatility and price swings stayed elevated but not extreme, with Bitcoin and ETH holding key supports, Bitcoin above 65K zone. Despite the equity sell-off, swings reflected macro sensitivity rather than crypto-specific catalysts. Trading volume trends moderated on the day, consistent with weekend positioning and lower retail participation. News, rumors, and external events included the same: inflation, AI, geo-cocktail pressuring risk asset, with no major crypto-specific headlines but indirect ties to tech disruption narratives and macro policy delays. Correlation with broader market remained high, crypto beta to Nasdaq equities, amplified by macro factors like sticky inflation and Fed outlook. Risk management considerations are paramount heading into the weekend, with elevated gap from news flows, potential forced liquidations in levered positions, and the need for tight stops or hedges given thin liquidity outside peak hours. In summary, Friday's close underscored a market in transition. Equities digested fresh inflation and AI reality checks with a defensive tilt, while commodities and, to the lesser extent, crypto absorbed safe haven and risk flow. The setup implies continued volatility into next week, with weekend headline risk from geopolitics or follow-through data potentially amplifying moves. Investors should prioritize liquidity, position sizing, and scenario planning. Opportunities may emerge in selective defensive or commodities, but the overarching tone favors caution until clearer signals of inflation trajectory and corporate AI adoption emerge. That's all I got for you guys today. And if you like the content, don't forget to like, comment, and subscribe. And if you'd like to support the channel, feel free to buy me a coffee on my Patreon. All right, bye-bye.